What is going on, best ever listeners? This is Matt Faircloth, and welcome to the best ever CRE show. And I'm stepping in under a different time spot with a different conversation with a different guest. So this is different and it's great. And this is going to be awesome. I'm here to welcome a new, and I get to like break the bottle of champagne across the bow of a boat today. I got my man, John Casmon, our new best ever CRE host, joining me here in the studio, so to speak, to talk about his new program that's going to be going on in the best ever CRE show. So look at how lucky you guys are to listen to this, right? John Casmon, welcome to the best ever CRE show.
Matt Faircloth, it is awesome to be here. Super excited, man. I got to tell you, this has been full circle moment for me. I've had a chance to know you obviously for a number of years, and Joe Fearless has been a guest and a fan of the best ever platform. So to now be added as a host is an awesome experience. I'm excited to hit the ground running, man, and bring some great value to all the listeners.
How many times, I know everybody's appeared on the best. A lot of folks that are in the circles have been on best ever, because Joe's had this show going on for like more than 10 years, right? So everybody, a lot of people I know have been on the best ever CRE show. A lot of people listening right now have been on the best ever CRE show because it's been around for a while. It's a daily podcast. Hey man, you have to interview a lot of people if you've got a daily show for that long. How many times have you been on the best ever CRE show?
Yeah, it's funny, man. Like I joke because like if you had a pulse in the early days, you were qualified to be a guest. And I remember the first time I was a guest, I didn't even know really what like podcasting was. And I reached out to Joe because I made a post on Bigger Pockets and some people tagged him. And I reached out and said, hey, man, I'm being in Cincinnati. Would love to meet. And he's like, hey, I got this podcast. You want to be a guest? And I was like, what? So that was the first time.
Slow your roll, man. Why are you going all the way there?
So
we're just dating. We're just dating, man. Why'd you go to that?
Yeah, it's so funny, man. So that was the first time, and since then, I want to say I've probably appeared about 5 times on the show.
Mm-hmm. Yeah, no, I know, and I know you've developed a personal friendship with Joe because you're lucky enough to live out in Cincy, and then in that part of the world where he does. You still live out that way, right?
Yes, sir.
Okay, cool. Yeah. So, I mean, I talked to you one time on and you were like playing softball with Joe Fairless and all that. And I was like, that's good stuff that you got, that you've, developed that, the circle relationship with him and all that. But beyond that, you're also in the same world as he and I are in the multifamily world. So I'm really grateful that you've joined the best ever hosting team here with this new concept that you've got here called Multifamily Mastery, man. Love it. You and I were talking offline about the term mastery, right? It's like Bruce Lee was a phenomenal, martial arts, call him a master, but he would even say that he was always learning in the journey, right? So you had said offline about the word mastery, and it's a dangerous word because people think that you achieve this mountaintop and then you're done, right?
Yeah, man. There's a book called Mastery. And it's a great book about the Aikido and martial arts in general. And it's a great book.
Yeah.
And one of the premises is that no matter how much time you put into something, no matter how much knowledge or experience, when you are on a journey and on a path, you never quite complete it. So that's what mastery is all about. And the thing I love is, with real estate investors, especially those starting out, they believe you have to accomplish a certain amount of things. You have to acquire a certain amount of information or knowledge or experience before you can do something. You got to wholesale before you can buy a rental, right? You got to buy some single family houses before you can get into multifamily. And you have all of these kind of rules that aren't true. And it really isn't about doing this before you do that. It's about being on this journey. And the thing that you and I love is with multifamily and commercial real estate in general, you are never really the expert. You may have a lot more experience than someone else, but that doesn't mean you're inflappable or completely, isolated from mistakes or challenges or issues that arise. The industry is always changing. The economy is always changing. Interest rates are changing. Investor sentiment is always changing. Technology, what's available to raise capital and do these different things. It's always changing. So it's really about the journey. It's the long-term view. It's about this road to mastery. And that's the way I want people to think about multifamily investing. Whether you have 1 door, 100 door, 1,000 doors, 10,000 doors, everyone is always trying to figure out what's next. How do I get better? How do I improve? How do I get more efficient?
Yeah.
How do I optimize? How do I get to the next level? And that road to mastery is really important. And we want to talk about some of the tips, insights, and tricks that others have used on their road to mastery in our new podcast, Multifamily Mastery on the Best Ever Network.
I love it, man. Yeah, I mean, because it's a road too, right? It's like I'm like it's like a navigational beacon that I'm heading towards. I might never hit that mastery point, and it's like I'm swimming out in the ocean and I'm going to swim towards the horizon. Well, I'm never going to get to the horizon, but it certainly will take me in the right direction if I do that, right? And so the concept of multifamily mastery, for me as a multifamily operator, and for you, and even for Joe, whatever, it's just a direction we want to go for best practices, right? And so I love that you're going to bring that. Let's bring it back even further. Why did you pick multifamily, right? Why multifamily? Why is it even an investment vehicle that people, and again, I'm preaching to the choir because anybody listening to this is going to be talking about multifamily because the show's called, right? But why did you pick multifamily as your vehicle?
So, I didn't grow up around real estate investors. So, as
Hmm.
I, like many of your listeners, started trying to figure out personal finances and, work situation, all that kind of stuff, I stumbled across that purple book, Rich Dad, Poor Dad, like many others. And that book was really good. And that taught me how to think about money. But it was actually the follow up, The ABCs of Real Estate Investing by Ken McElroy. That book
Yep.
was the first book that helped me really understand this concept around multifamily or apartment investing. And I recall in there, Ken talks about investing in smaller projects first and wishing that he got into multifamily and that you can start in multifamily, even large multifamily. And I remember not, just there was a disconnect. I just didn't get like, yeah, if you got, millions of dollars, you can start in multifamily, but like the average person probably can't do that. And
Yeah.
later on down the road, I learned about, OPM, raising capital, other people's money, and like syndications and all those things. But the real thing for me was every time I read a book, listened to a podcast, read an article, anybody who was a real estate investor and got to multifamily, they all, without a doubt, they all said they wished they had went to multifamily sooner. And I remember
Mm.
reading that over and over and over and saying, well, why don't I just start there? Now, for me, that meant small, right? 2 to 4 units.
Yeah.
That was
Hmm.
residential multifamily, but I wanted to start there. And I was in Chicago. In Chicago, there's more 2 to 4 units than actually single family houses in many of the neighborhoods I was living in and investing in. So it was a natural fit to start in smaller multifamily. But it's all the reasons people love, right? It's the scale. It's the ability to eventually bring on property management companies. It's the ability to operate and see a larger vision, which with the houses, it's,
Hmm.
it's harder. The financing is a little
Oh,
bit
yeah.
easier there. So all those factors really attracted me to multifamily.
Yeah. And it's like, here's my perspective, right? I know you didn't ask, but I'm gonna tell you what I think, right? Uh, residential, like housing is a core human need. And Fairless said that to me when I was at Best EverCon, running around asking people like if they were a bull or bear on today's, where we at. And Fairless was like, I'm always a bull on housing, on multifamily, because it's a core human need. We need more housing. If there is a downturn in the economy or whatever, we will still need housing. We might not need as many strip centers or self-storage centers or office buildings, whatever it is, but we will certainly need more and more housing as America continues to grow and flourish and whatnot. So, by that rationale, you need more of that. And as you said, I can play more of the economy of scale game in multifamily. So, if you believe that America needs housing, why would you not get into the multifamily world or in just building a lot of housing or rehabbing a lot of housing or providing more housing to more people? And if you do it in a single site project, like a multifamily project, it just becomes a little easier because of the economy of scale. So I think it's just a logical transition for those that believe in housing as their investment vehicle.
It,
Just multifamily is just a logical transition.
and Matt, let me say this too, right? The thing is, commercial real estate can be very intimidating, especially if you don't understand the lingo
Hmm.
and speak the language. I listen to a guy like John Chang break down, the economy and economic factors and all that.
Oh
I'm
boy,
like, whew, this dude is brilliant, right? But
he sure is. Yeah.
I went to a state school, very smart, but there's there's a ceiling on the knowledge, right? So part of it is
Yeah.
it's understanding the simplicity of it. And thing with real estate investing
Hmm.
is if you can do third or fourth grade math, you can be a real estate investor. we
100%.
overcomplicate things to a degree. So part of it is being able to simplify it and keeping the focus on the key metrics that matter and then going really deep. So we talk about that mastery and that road to mastery. There's a bunch of nuances that you want to learn. And certainly you want to listen to the John Chains to understand these details. But starting out, it's really understanding the macro things. And at its core, it's about housing. As you said with you and your conversation with Joe, people need places to live. It's really
Mhm.
expensive to go out and buy a home today. Interest rates are high. The down payment needs are there. People are not making as much money. Inflation is there. So this simple, formula of supply and demand, it's there and it's in our favor. There's no sign that it's going to pivot or swing back in the other direction anytime soon. So
Mhm.
multifamily provides a great option for housing for Americans. Now it comes
Mhm.
into the valuation and the metrics and some other things there. But I like to think of it this way. And I was just talking to Ash Patel about this last week.
Mhm.
We were talking about, retail and strip centers. And I said, the thing that I think most people struggle with the other asset classes is one, to get into those other asset classes, there's a little bit of a higher level of knowledge and confidence to compete because there you're competing with other pure commercial real estate investors, right? When you're talking about housing, even if it's multifamily, most people understand worst case scenario, a tenant moves out, you can go out and get a new tenant. If
Mhm.
you have a CVS and they move out, most of us
Yeah, boy.
recognize it is not that easy just to go and grab a Walgreens or whoever else to move in.
They're not gonna Walgreens likely is not gonna take it for any
For
number of
so many
reasons or
reasons.
whatever.
So many reasons.
Yeah.
You even have a strip mall center. Like now, technology, you're dealing with, things that Amazon are coming in. And it's not to say one's right or wrong. I'm just saying at its core level, if you know nothing about real estate investing, you understand at a high level how apartments work. You know, people go there, they live in it, they pay rent,
Yeah, I
and
do.
there's some expenses, and whatever's left is profit, right?
Mhm.
With and you also know if someone moves out, you put an ad out on Zillow or apartments.com,
Yeah,
whatever,
yeah.
right? Like people conceptually get that really, really quickly. When it comes to the other commercial strategies, industrial and office, I think people recognize it's probably a little bit harder. There's more questions that you have, which is great for Osh because you have less competition. But on the same note, I
Sure.
think the room or the margin for error is slimmer because if you do mess up, you probably don't have some other investor who's new or maybe not as experienced who could come in and save you. I mean, I remember I did a project, did a flip project. It went terribly wrong, by the way. But I did a flip project. And the challenge for me was, or the benefit for me was, well, maybe someone would just fall in love with the house, right?
Mhm.
Because economically, if you ran the numbers, there's no way in the world it would sell or should sell for what I was hoping to get or what I needed to get. But I was praying that somebody just happened to live in this neighborhood or needed to stay in this neighborhood and needed to go to that school or wanted to live on this street. And we ended up finding someone who really did like it. Not exactly the numbers I wanted, but they were able to buy the property at a number that at least allowed us to exit. That doesn't happen often in commercial real estate. Now, again, when the market was really
Yeah.
frothy, you could get that in multifamily, some of the asset classes. In today's environment, that's not happening. So if you don't buy
Mm-mm.
right and manage right, it's going to be really difficult to exit at a profit. So you just have to understand that's why we're staying on this road to mastery because you want to know these things going into a deal so you can protect yourself and any potential partners that you might have.
What are as in your road to mastery and as you host this multifamily mastery show here on the Best Ever CRE network, um, what are some things that you hope to convey to the listeners? Because I think there's a lot of misunderstandings about multi for rising operators. I think a lot of them that I've met, including myself in my younger years of real estate investing, were focusing on the wrong things, right? And there's also some misunderstandings about what multifamily mastery really may be. So, what are some core lessons you're hoping the best ever listeners can glean from the multifamily mastery segment?
I think the first thing is really guiding principles to investing.
Hmm.
So, really
Yeah.
understanding the foundation, guiding principles, the kind of things you need to be looking for at every investment. And I'll give you one. There's a lot of conversation about bridge debt, right? And floating rate debt.
Yeah.
And
Oh
oh,
boy.
it's bad, oh, it's good, whatever it is. And there are a lot of strong, and I'm talking super intelligent, highly successful investors who are
Hmm.
swearing off of bridge debt. Bridge debt is not the problem. The problem is people aren't putting the right business plan the right property, the right upside with the right loan product. Certainly, bridge
Wow.
loans
All
have
right.
more variation and more risk involved, but that just needs to be paired with the right opportunity. If I gave you a deal where you were going to increase the value, let's say threefold, you
Hmm.
probably wouldn't want to put a 7-year fixed rate loan on there after you've, increased the value 3x over a 2-year
Yeah.
period, right? You got
I've
all
seen
that
people
equity
do that,
locked up
John. I'm like, why are they doing that? Like
because
they're
it's the
buying a like
fear.
they'll buy a property for like, 7 million bucks and they'll go and raise so much on the front end because of the amount of work that they're gonna have to do to it. But they're so afraid of that third rail, bridge debt. They won't touch it. And so they gotta raise like they'll go in on agency on a big value add deal because they won't touch bridge debt. It's like, okay, I get it, and that's conservative, but you also put a noose around your neck in the amount of capital you got to raise to get into the deal. That's well said. So this misunderstanding debt instruments,
Yeah.
and just using it as an instrument. It's just a vehicle to get you where you want to go. I love that.
Yeah, exactly. And that's just one example, but it's really just understanding like, again, you've
Hmm.
got to put together the whole thing. You can't just take one thing you hear from Matt or me or someone else and just run with
Yeah.
it. You've got to actually step back and put together a true business plan. And I think
Yep.
that's the challenge. Some people just use spreadsheets and they slap some numbers into Excel and it lights up green and they're ready to go. It's like, no, did you
And I
did you
can't
s-
just tweak my Excel model till it
yeah.
lights up green. Like, well, let's see, like, John, what happens if I drop the cap rate a little bit?
Yeah.
When I
Yeah.
sell it? Wait, like, what happens if I just increase rents by a little bit more? Right? Like, maybe I can make those numbers turn green. That happens, right?
Absolutely.
So maybe that's another thing for the show. Of course, is just underwriting, like having certain standards for yourself for underwriting. I mean, it's okay to say no to a deal. You don't have to force the deal. And that is the biggest mistake that I saw a lot of people make over the last couple of years is they start forcing deals to get that acquisition fee, and you end up overpaying, over leveraging, using the wrong debt instruments, check all the wrong things to do. Before you know it, they got a really big problem.
Yeah, and I think this is
You
true
know?
with all business, but the other thing that happens there is as you're going through that process, well, some of those assumptions are changing and you're not counteracting the changes in the assumptions. So for instance,
Mm,
if I need to bring a little less money to the table, I can get a higher IRR. Okay, but what are you foregoing by bringing less money to the table? Like
mhm,
now you have maybe less in reserves, or now maybe you need this to happen, or whatever the case is. You've actually increased the risk profile by making another change, and you haven't really balanced that with the business plan. So it's stuff like that which gets into the nuances a little bit, but I think it comes back to really understanding what you're trying to do. And the thing that really helped me as an
mhm.
investor, at least on my track here, is stepping back and recognizing that it is business, and
Yeah.
it's a business plan, it's a business. Yes, it's real estate, but when I was starting out, I treated it like it was something completely different, right? Because it was like
Mhm.
construction, it was property management, and that was not my background and my expertise. But I did spend 15 years in corporate America doing advertising and marketing, overseeing big budgets, $100 million advertising budgets, putting together brands, overseeing sales strategies. So
You were in the auto
I
industry
was
from
in
what
the
I
auto
remember, right? You were
industry. I
over the
was in the
over the
beer
Pontiac
industry.
brand, right?
I was
Yeah.
the last of the Mohicans with the Pontiac brand. I helped close that thing down. Uh, but
Yeah.
even that process where we had to make some tough decisions, it taught me a lot because we had people who, I mean, that's a tough thing, man, to close an auto brand. First of all, some of those people are
Oof.
super passionate. We had the
Oh, geez.
Firebird and the GTOs and the Trans Ams, and we had these like legendary vehicles,
Oof.
and people are
Yes.
like, "You're telling me though, like they're all dead, right? We're gonna close this thing and they're gonna die." But the truth is, you can't live in the past.
Yeah.
And as we looked and projected forward, we had to say, what would this brand look like moving forward? We had three options. And as we looked at the three options, neither were really viable. And when you looked at how the industry had changed with, Tesla starting to emerge and Japanese automakers, really thriving, we had to change it up to really compete and give ourselves the ability to
Absolutely.
do that. And that's something I think we all have to do as investors and as business owners is take a look at where the market is today, but also where it's headed. Don't worry about what happened 2, 3 years ago, or 5 years ago, or 10 years ago.
Mhm.
Like it's really not relevant. You have to really focus on where the landscape is going and make the appropriate adjustments.
I love that. I think that's a great angle to bring to the show, best ever listeners. In that, like, people that I talk about are still talking about COVID. People that are still talking about when rates changed. Okay, why are you bringing up old shit? First of all, like that was a long time ago that these things happened. How do you make deals work today? Right. Let's talk about that on the show. And I love, John, that you're talking about what's happening today versus reeling from things that happened in the past. And the market, the multifamily market's still correcting in a lot of ways from things that happened a few years ago. But let's also talk about how we get deals done now. Um, how do you plan on bringing? I see a lot of people, and and I know you've got students that are learning from you and whatnot. How do people, errors that you see they're making on the acquisition side, and what do you plan to bring for good acquisitions tactics and good acquisitions methodologies to this program?
Well, on the acquisition side, I think first of all, you have to get clear on your criteria. And for a
Hmm.
lot of people, their criteria is only based on IRR, right? Does it hit a certain IRR? Awesome, let's do it. And I think that's a huge mistake, right? So you have to understand both I call it two ways, right? One is the metrics, the return metrics you're looking for. The other is the property metrics. So what kind of properties do you actually want to own? What kind of properties are you equipped to actually manage? Because if you don't have
Mm.
the team to take down a certain type of deal, don't do it. And that's where people make mistakes. You've got to understand, what does it take to execute this deal. So once you got to have those two things, now you can really lock in on your acquisition strategy. I think one mistake I see people make is they want to get off market deals. And I know that sounds crazy, right? It's a mistake. Why wouldn't you want off market deals?
Yeah.
Well, half the time, off market deals are not really off market. Let's just start with that.
Oh,
So it's a pocket listing. It's already with the broker. Maybe it's not being mass marketed. But the truth is, especially when you're getting to, let's call it 50 plus units for
pocket listing
multifamily,
thing's a trap. That is a trap.
it,
I've had so many brokers call you, "Oh, I got a pocket listing. I got it off the market deal or whatever." No, you do not. You're calling 30 other people too. You don't love me. You're calling 30 other people and tell them about your pocket deal you got. So best ever listeners, if a broker ever calls you to get a pocket listing or an off the market deal, guess what? They're calling somebody else right after they call you. You are not special. So
I think one of the best things
yeah.
to learn about kind of how the game really works is when you're
Yeah.
a seller. When you're I don't know if you've had this experience, right? But like, you obviously start out on the buyer side, so you spend most of your time doing
Mhm. Of
that, building up your
course.
portfolio. But once you start selling an asset and you get to talk to these brokers as a seller, and they're telling you their strategies and what they're going to do and how they're going to drum up, the price, it's like, huh, okay. Now the curtain's pulled back, and you're starting to see some of the
Oh,
tactics that they leverage and they utilize,
so many.
and it gives you so much more insight to how the game is really played. And then you got to call them, a week later on another deal you want to buy. It's like, oh, this is, you can't teach me
I
the
didn't
game and then run the game on me.
I know, right? I didn't really understand why things were the way they were on the buying side. And maybe you and I can go there for a second as a tangent for the best ever listeners that have not sold real estate yet, sold large real estate yet. When I did, that answered so many questions I had as these games that brokers play. So you've sold as well, right? So let's go here for a second. If you got a piece of real estate that you're thinking of selling, the a broker may do this. They might say, "Hey man, I got a guy with a 1031 exchange and he needs to buy right now. Like he needs to close like last week, and he's got a sense of urgency and all the whole story. And so all you got to do is give me your trailing 12, meaning 12 months worth of performance and your rent roll, and I'm gonna send it over to the guy, right?" Now, John, for those of you guys not watching the video here, John just did a fish reel, like they're fishing, right? And once you give that to them, before you know it, everybody and their mom knows about your deal, because what that broker did, they took your I'm sorry. You give them three things: your rent roll, your trailing 12, and your dream number. I will sell it for $10 million, 15 million bucks, whatever it is your number is, that would be your make me move number. Like that's what I would sell this property for. Now the broker's got all they need, and they will go and call everybody in their Rolodex. They can't do a big mass marketing email, but you've gave them a pocket listing. You've given them what they're calling you on the when you're on the buying side and calling it an off the market deal. Here it is. Here's a rent roll. Here's this. Here's that. It's hush hush. But this is what they're saying they want. What do you think? I mean, That's how it all evolves, right, John? I mean, I've had that happen to me unbeknownst to me, like thinking it was just go to their 11031 buyer. Before you know it, it went to the whole world, you
Yeah,
know?
that's the game. Listen, and I'm so happy you said it that way because that is the
Yeah.
game. I've had it run on me multiple times, and it always sounds legit. It always sounds genuine, and it can
Oh,
come
yeah.
from brokers you have a relationship with, brokers you've never talked to. I've had brokers in different states reach out and say, "Hey, I've
Oh,
got this
yeah.
guy. He's got a 1031 exchange. He's looking for this kind of deal. Your property fits. He can go." So the thing that some of them will do is they will give you a number. He can go up to 17 million. So if your number is actually
Mhm.
15 and you're like, oh, this guy can go
So
up to
you know,
17, you're
pay
like,
you
of
more
course
than
I'll
what
send
you
you the
want.
T12
Mhm.
and the rent roll, right? And then they come
And you
back
start
and
doing the math, figure out how much money you're going to make on that sale, what your IRR for investors are going to be, and
yeah,
you're like, yes,
yeah,
17 million,
yeah,
I'll take it.
yeah. So that's
Oh, all of a sudden that
definitely one of the
investor found
games.
something else.
Yeah,
Yeah,
that's
but then that investor found something else, didn't they? And now I can get you 13,
yeah.
Right.
Or
Yeah.
well, now they either he found something else or they start to run the numbers and now they're coming back. Yeah, hey, so he can go up to 17, but for this one, based on the numbers, I think it's more like 12. It's like, okay, well, dude,
Mhm.
that's a way different conversation, right? So
Yeah.
that's part of it. I would say that's probably the certainly a more deceptive
Yeah.
approach to take. The way it, the
Yeah.
way it should go, the more above board approach is for a broker to
Sure.
reach out and say, hey, listen, I'm happy to give you a BOV, which is a broker opinion of value. And then they're going to
100%.
take those numbers. They're actually going to put together a package and share with you to give you some context of where you think the value is today. So that's something I would
That's the right
encourage
way to
people to
do it.
take. If you've got a couple of brokers, particularly brokers that do a lot of deals and a lot of transactions in the markets you're shopping in and you're playing in, then you'll want to do that because they're going to be able to tell you, hey, it's worth this today. But then also, if you do decide to sell this, these are probably people you're going to sell with. On the flip side of that, when you're looking to buy, it's going to help you build up that credibility, build up the relationship with them. You understand how they look at the deal. I always like it because when you talk to multiple brokers, you get a sense of how they value things. You can figure out who's aggressive, who is really
Yeah.
conservative. If you get three BOVs, I mean, typically one's going to be way beyond what you think is really worth. But they're going to, again, when you're the seller, you can hear how they talk to you. So they're going to say, oh, we're going to do this, we're going to do that, we're going to push it, oh, we can do that. All right, well, now I know as a
Right.
buyer also how you operate, right? So as a buyer, I know your
100%.
number is probably inflated, which can be good or bad, by the way, because if I know they're coming with a number that is a little bit high, then I can kind of wait them out and see. Because if they
Mhm.
don't hit that, well, now they kind of have to go back to that owner and explain why they thought they could get $15 million, but all the offers came in at 12, right?
Yep.
So now you have
Here's
a
your
little bit
bucket
more
of cold
leverage
water,
there.
owner.
Yeah.
Yeah.
So it's there's leverage in the knowledge, but you just have to understand the game.
Yeah. I think that, like, I'll give you one more inside baseball thing that I've learned when I've sold, and it explained a lot of experiences I've had when I bought. By the way, best ever listeners, this is what you're going to get a lot of on the Multifamily Mastery Show here with John. Is a lot of inside talk that's going to give you. This is how you're going to learn. Is real industry experience from real guests that John's going to be bringing on to the show. So I'll give you another one. I have sold and the broker and I agreed upon a what you would call a strike price. Let's just say for fun, we'll keep with that $15 million number, right? So that's what the broker's BOV is. Great. They'll take a certain commission on that number, 1%, 2%, whatever it may be. But if they can get you over that number, let's say I trade for $15.1 million, 100K over, right? Well, the broker then gets a piece of that overage above that strike. That means that if it trades for 15.1 or even 15.5 or whatever it may be, they could get 10 to 15% of that overage. So that means if it trades for 15.1, like I said, they get a $10,000 bonus to their bottom, to their pocket in their commission, right? That explains, John, and a lot of brokers were willing to do that. I think quite a few of them are. So what that means is that the more they push up that what the property actually trades for, the more money they make, not just in a percentage of the sell price, but in an actual profit share and an override that they get on top of their commission. Man, that explained to me, John, why a lot of these brokers pull this best and final, best and final, final, best and final, 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 final game. And when you're under, like, you're, oh man, you've made the third round of best and final, and and the number is 15, what that they really want. But if you could go to 15.5, I think you can get the deal. And then of course you go to 15.5. You know what happens? They go to the other buyers. Hey man, Did you know that other guy just went to 15.5? Can you believe? What are you gonna, And then before you know it, the number's now 16, right? And I think that arrangement with brokers are what pushed a lot of the market up over the last 10 years, because if you tie the broker's compensation to driving up price drastically like that, you end up in a market where the seller thought that they would settle for 20 million. Before you know it, the property trades for 22, 23 million, a good bit more than what they're asking. And then that's now a market comp, like, no, okay, now the market's 150K a door. So the next person that goes to sell thinks that they should be getting that too. And before you know it, these things are riding up, and these brokers are doing very, very well in that rising market that was in the past. But it still explained to me why these brokers can get very aggressive during that round of best and final and best of final, and they'll use you against each other as a bidder. Your thoughts on that
Yeah,
arrangement?
and listen, kudos to those brokers, right? That's their job.
Hey, God
Their
bless,
job is to get the highest transaction price for that
and they do
seller.
it.
And I think that is the misnomer if you're new. And if you come from residential real estate, I think one of the biggest things that may be a surprise is that commercial brokers, they are technically dual agents, but most of the time they truly just work for the seller. And
Mm-hmm.
you have to understand that. The seller, they know. The buyer could be any one of y'all. Okay.
Mm-hmm.
So for that seller, that is the person they have a contract with. That is the one they have an agreement with. That is the one that they are working with. They are out there looking for the
Fiduciary
buyer. That's
responsibility.
it.
Yeah.
That's it. So their
Yeah.
job is to get that number as high as they can, whether it's through a
Mm-hmm.
bonus structure or simply it's a percentage. So they get a 1 or 2%. Well, 1% on a $20 million sale is much better than 1% on a $10 million sale. So they're going to push to get
Sure.
every dollar that they can. And if you can get outsized returns, where to your point, you've got the strike number, and then above and beyond that, you get a little bit more, that's even better, right? They're incentivized to push. What I think you have to keep in mind as a new buyer, though, is when everyone was looking to buy, it was easy for those brokers to do that, and they didn't have to work very hard.
Mm-hmm.
And here's the example I'll give you. A couple of years ago, if I got a deal sent to me and I sent an offer, the broker really didn't like my offer. They'll probably just tell me, hey, man, we got some other offers that are higher. And that would be the last time I hear from them. About 6 months ago, I would send an offer. If the broker really didn't like my offer, they would say, hey, man, do you think you get your offer up a little bit? Hey, we really like you. And we just want to see if you get your offer up, right? And if you can't, okay, they'll wait and see. Now, if you send an offer and they don't like it, they will probably tell you, hey, man, listen, we really want to work with you. We think this can work out. What can you do? Right? It's the tone just shifts because there's
Mm-hmm.
not as many offers. There's not as much competition. Investors are pulling back. They're more conservative. And in the past, people would trip over themselves to pay a premium. And that's just not happening today. So I think you have to understand the landscape and how it's shifting. The other thing I
Mm-hmm.
would say is with brokers, they're called brokers for a reason. Their job is to broker a deal. And again, in the past, if you've got 10 people, who are looking to buy a property at a premium, who wants it more, you can just treat it like an auction pretty much, and you'll get that. That's not the case today. Today, they truly have to work. So I would say as you're working with brokers, you want to work with brokers who are actually focused on working with both sides, understanding what
Mm-hmm.
the seller needs, understanding what a buyer needs, and then working in between the two parties to help a deal get done. The thing that people forget is brokers don't get paid until a deal closes. So you could go 6 months working on a transaction, listing a property, doing all the marketing, talking to potential owners and potential buyers, and not have a transaction go through and you never make any money on this. So they are heavily incentivized to get a deal done. And it's not as easy to do that as it was a year ago or 2 years ago, where all you had to do was push a button and email blast this deal out to everybody. Today, you've really got to get into it. You've got to answer questions.
Yeah.
You've got to understand the CapEx. You've got to know the narrative and the story. You've got to get the seller to be reasonable with terms
Yeah.
and conditions and pricing guidance. So it's much more challenging in today's environment. But as a buyer and as an investor, it's an amazing time because you can go out there and get deals that you would not have been able to buy 2 years ago.
And I think that best ever listeners, that's the reason why I want to underscore one thing that I said before, and that, like, it's not 2022 anymore. It's 2025, going up on 2026, and forward from there. the things are constantly changing, and by listening to industry experts that Best Ever is going to be bringing on to chat with John and you guys here to listen from are going to be giving you today's industry standards, what they're doing to grow today, find more deals today, and fund your deals today. And John, let's transition to one thing. And that's one thing that nobody ever wants to talk about. So don't stop listening, Best Ever listener. But there is this thing called operations. Then once you buy, yes, you found a deal. Yes, you got it funded. Congratulations. But here's the problem. My partner Justin always says, "Don't pop the champagne yet. Once you close, right? You can pop the champagne once you sell it." But that's really where success in multifamily is through successful operations. John, what are some like errors or mistakes or just misunderstandings that you've seen your students or people that you've met make on the ops side when with deals? Because like I said, you buy them, you fund them, and then the work begins.
Well, I think the issues and mistakes you make fall into one of three buckets, right? It's either a
Mm-hmm.
process issue, it's the people issue, or it's a partnership issue. So
Yep.
on a process, maybe you don't have certain things like leasing, right? You don't have a clear leasing process in place. Whether you're working with a third-party property management company, whether you're self-managing, have you identified what that leasing process is? What credit score do you take? Like, do they need to do a deposit? Do they need to do a move-in fee? Like those things, they're all a bunch of decisions, right? But they add up over time and it can be a challenge. So I think, understand your processes is the first thing. Then people, do you have the right people? Are they trained on the processes? Do they know what they're supposed to do? But maybe they're not the right folks for you or for this job. And then the partnership, sometimes you have good people who understand the process, but maybe you just don't have an aligned partner. We've had to move on from property management companies that didn't see eye to eye with us, maybe told us one thing up front and we got into the execution and it wasn't exactly what we were expecting. So that happens. So I think the biggest thing though, when you come into the operations side, it's people really tend to rely on the property management company, right? It's we
Mm-hmm.
bought this property, I'm hiring this property manager and they think they're done. And they don't understand the role of asset management. And asset management is very different from property management, but there's certainly some overlap. And the more you understand the role of being a great asset manager, the more likely it is for you and your projects to be successful. And that asset manager is really like the CEO. Your job is to understand what everyone underneath you needs, the contractor, the property manager, the leasing agent, investors. What does everyone need? And how do you steer the ship so that everything is moving in the right direction and you're giving the right resources, the right attention, you're giving everything that the project needs to be successful. And it's challenging. And I'll give you one real tactical and tangible example. Let's say leasing is down and you need to increase leasing and occupancy. Okay. If you go call your leasing agent, your property manager, they're likely going to tell you that you need to spend more on marketing, right? Or they'll say, "Hey, we need to buy an ad in apartments.com or we need to spend more money on Zillow," right? That's a very easy solution for them to come up with. As the asset, you've had this happen, right? Right?
I'm laughing because that's always the
That's always
answer.
the answer,
It's like
right?
it's not me, it's you,
Yeah.
Mr.
Yeah.
Owner. It's not
Yeah.
me as your property manager. You need to spend more money on marketing. You need to do other things to get these eyes to your
It's
property
the first
so
lever.
that I can then
Yeah.
easily close these folks.
It's the
You
first
know?
lever that they want to pull because it's easy. I would push as an asset manager. I always have to
Yeah.
push back and push back pretty hard. I've got to understand traffic. Well, when you say we need to spend more marketing, what I hear is not enough people know that this property is for rent. So is that the
Yep.
case? Or are we getting people coming through, but they're not filling out applications? Are we getting applications, but they're not qualified? We've got to actually understand the real problem we're trying to solve. And as you push as an asset manager, now you have more levers you could get into. Now, instead of spending more on marketing and rent.com and all these other websites, you might say, hey, let's do an open house or let's go old school and let's put flyers up at the local grocery store. Or let's do a resident referral program, right? So you
Yep.
can now figure out how do I actually improve occupancy and leasing without necessarily increasing the marketing budget to $2,000 a month for, rent.com and some of these websites, which
Mm-hmm.
sometimes works, sometimes doesn't work, but it's definitely inefficient and less effective as some of these other strategies. So it's things like that, but then you take that across, all of maintenance,
Yeah.
all of construction, everything else that comes with property management. So it's really understanding how to drive efficiencies and operations to be successful.
I think that, John, looking at a good asset manager and an operations manager of an existing multifamily project, the ones that really do a great job of it know what data matters, right? I mean, there's a
Hmm.
lot of data that comes back. So on the leasing side, how many showings did we have? And how many call-ins? How many people called in or made an inquiry about that? Okay, so let's say we had 30 inquiries in a month or in a week on a multifamily asset. How many of those inquiries turned into a tour? How many of those tours turned into an application? And how many of those applications converted into a lease? There is, if this, then that data and answers and things you could do behind each of those data points. And as you said on maintenance as well, how many maintenance work orders do we have open? How long are they open for? All those things. These are things that a property manager certainly could deliver the data point to the asset manager, but the decision on what to do with that data really needs to fall onto the asset manager. And I go back to this,
Matt,
the
I want to push
interest.
back on you a little bit there.
Push,
Uh,
oh, push, do. Let's
Here's
push.
I get what you're saying, and for you guys like you and I, that's what we would expect. The truth is, we've got to keep in mind, like the property managers, like it's not their investment, and
That's
they
right.
haven't been trained. I'm going back to my
Yeah,
process, people, or partner thing. If we haven't trained and taught them to think about the business like an owner, and I mean like a true owner with equity, they're not going to do that. Like if you were a
yeah.
manager at McDonald's, like you don't wake up and sit there and say, you know what, I feel like we're wasting a lot of ketchup packets and napkins, and like they're not sitting there analyzing all that. They're making sure they got the shifts covered. They're making sure
That's
that
gonna call you up, say, "Hey, man, we need more ketchup."
yeah,
As
we
the
need to order
owner,
more
if
ketchup.
you own a McDonald's, the
They're
business
not
manager, "Hey,
sitting there
now."
and running analysis and spreadsheets on how much waste the organization. They're not doing that, and it's
Yeah,
silly to expect them to do that. Their job
that's
is to
right.
manage the day to day of the business, right? So it's on
Mhm.
you to be the asset manager and oversee it and say,
That's
okay,
right.
hey, you know what? We're taking a lot of time on this, so our turns are not moving as quickly. It's nice if they did that, but I think the expectation that these people are going to be both qualified as well as proactive to dig into the data when you've got tenants in your face talking about, I got this issue. You got 3 leases that you got to get signed by the end of the month. You got 2 showings going on. You got, these staff members having these issues. They're trying to manage all of that. And to
Mhm.
sit and think that they've got time where they can just sit and look at data and
No
numbers
way.
and say, you know what, I wonder what the most effective marketing strategy is to lease our 2x2s, because the 2x1s are doing great, but the 2x2s seem to be a little under. They're not doing all of that, right?
Yeah.
They're gonna do the best
Maybe
they
we've
can.
overpriced them. Yeah. Yeah, yeah, yeah.
They're gonna do the best
Right.
they can, but I think we also have to
Yeah.
just be realistic with their level of training and what they can deliver for you.
And what their end goal is, right? Their end goal is to keep the property as full as possible. They're like, it's almost like their end goal is to make their management fee and not get fired. You know, and not to like boil it down as a property manager, but not for nothing. That really is the more money that the property brings in, the bigger their fee is. So maybe they don't care if you rent all out to Section 8. Maybe they don't care if you've just got, if they drop the leasing standards a little bit so they can get some more warm bodies into the building. A less scrupulous property manager might make some decisions like that. But an asset manager has to look at it very different. It's not just about bringing dollars into the door. It's about accomplishing the long-term business plan for the asset. And they don't like the property manager's not tied to that. So that's a huge correlation between asset management, property management, and the mistake that people make in AM. Because I've seen people do the mistake that you said at the beginning of group of doctors that all have like this is a real story. Group of doctors went and bought a 30 unit in one of the markets that's one of my sandboxes. And they just funded it, of course, with their own, because doctors make a lot of money. So they all just got together, wrote themselves a check, but they all are busy doing what docs do, right? Like they were being doctors. And so none of them had daytime availability to
Mhm.
browbeat the property manager into, cooperation and all that. So the asset kind of languished because the PM did their job, but nobody was over them aside from these docs that had full-time day obligations. So those are real mistakes that folks can make. And guys, we're going to be bringing you real stories and applications and ideas through the Multifamily Mastery Show here that you guys can apply to your multifamily mastery journey. So, John, as we'll be bringing home Give me, the final thoughts that you plan on bringing to the Best Ever CRE show. Super grateful that you're going to be joining us. Give me any other final thoughts you got on what people should tune in for.
Yeah, I mean, listen, it's great conversations. You know, you want to learn from folks who are on their journey, whether they are starting out, whether they're in the
Yeah.
middle part of the journey, the towards the latter part, more established. I think there's always insights we can uncover from listening
Mm-hmm.
to what others are going through. And sometimes it's just reminding ourselves of things we already know. Trevor McGregor, he often says, if you hear yourself saying, I already know this, ask yourself if you're applying it, right? Because
Yeah.
a lot of times we know stuff, but we don't apply it. And that's really the challenge that we face in our business. So, our goal is to really just bring those insights, help you on your journey to mastery and multifamily, and really give you the tools and resources necessary to grow and scale your portfolio, but doing so based on the current market conditions, not something that, was practiced 5 years ago or 10 years ago or even yesterday. We really want to keep it current and understand the strategies, insights, tools, and tips investors are using today to build,
Mm-hmm.
maintain, and protect their portfolio.
100%. So, Best Ever listeners, if you've got something, if you got a tactic, acquisitions, funding, operations, underwriting, any of those things that you feel like you've, I don't say figured out, but that you've, mastered to a point where you'd like to share it. No promises, but you can go to bestevercre.com and there is a spot on the website that you can apply to maybe be lucky enough to be a guest here with John on the Multifamily Mastery show here on Best Ever CRE. And by the way, quick plug, if you guys are listening to the Best Ever CRE show, that's what I love about working with Best Ever. You can check out my shows, Next Level, which is about taking your business, your life, everything that you're in the middle of to the next level, because there's always a next level to mastery. Dirty little secret, you're never going to hit mastery. You're just going to get closer and closer to it every day if you're on that path. My show, Next Level, is all about what next things we can be doing to approach a mastery on our journey. We've also got, as we said, super smart people that are smarter than me and John Casmon. We got John Chang, who's an economist, right? Telling us, he's reading the tea leaves and telling people like me and John Casmon here where the hockey puck's going. It's great to hang out with smart people. So John Chang is the smartest out there in the economy world. So listen to his show. Listen to Joe Fairless. Joe is going to be talking to us about AI. Guess what? It ain't going away. AI is two little letters, but they are very big ones, and it's not going away anytime soon. So how can you implement AI strategies into your business? That's coming up on the Best Ever CRE channel as well, and many other conversations, including yes, John and I are big multifamily guys, but there are other things you can do. So Ash Patel and Amanda are going to be talking about things on their Beyond Multifamily show, because there are other asset classes you can invest in. We forgive you. It's okay. You can still look at other multifamily stuff too, but you got to listen to mine and John shows as well. And that's, so you can listen to Ash on Beyond Multifamily as well. And if you're a passive investor, guess what? John and I both passively invest. You can listen to Pascal Wagner for the passive investor's journey, right? There's a lot of passive investing strategies. There's bad moves you can make as a passive investor to build your wealth, and there's great moves you can make. Pascal's uncovering all that too, and many of the other hosts, including hosts that you don't know about yet, because I'm not done making changes here at the Best Ever CRE network, guys. We got more folks, more conversations that are not ready for prime time yet that are on the way. So stay tuned to the Best Ever CRE program, because we're going to be constantly adding new talent, going to the next level with Best Ever, and making this show continue to be the best ever program that it's been for 10 years plus. And all the things that Best Ever has to offer you, including Best Ever conferences and education products. All those things are all coming at you guys, all from Best Ever. So, John, I am super grateful to have you as part of the Best Ever family. Dare I say that? And I'm looking forward to hearing myself listening to your show and what you bring to the Best Ever CRE network and that. So thank you for joining us, and Best Ever listeners, for you guys tuning into John's program weekly.
Matt, thank you for having me. Super excited to be launching
Yeah.
Multifamily Mastery and kicking things off, man. Looking forward to this journey together.
Yeah, it is on the way, Best Ever listeners. So mark your calendars for the show. It's going to be coming at you every week. And that. So thank you guys for listening, and we'll talk to you soon. Thanks.